Welcome to Casa Academy Chapter 18, Part 3, where we will cover taxes affecting real estate. You know, there's a pretty well-known saying that absolutely nothing is certain in life except death and taxes. And yeah, while property taxes are just a normal, everyday part of property ownership, Florida law actually provides some really fascinating exemptions and limitations. These mechanisms can significantly reduce, and in some very specific cases, completely eliminate the amount of tax a property owner has to pay. Understanding these is how you shield your future clients' wallets, so let's get right into it.
Here is the roadmap for our explainer today. We're going to cover exemptions versus immunity, the taxable value formula, Florida's homestead exemption, additional property exemptions, and finally, the Save Our Homes protections.
Section 1. Exemptions versus immunity. So what exactly happens when property taxes are reduced or just avoided entirely? Well, there's a very clear contrast between these two classifications. First, we have exempt property. These are properties that absolutely do get an assessed value from the county, but they don't actually pay property taxes because they qualify for an exemption that's equal to that assessed value. Usually, we're talking about churches and certain nonprofit organizations here. Essentially, they get their tax bills zeroed out. On the flip side, we have immune property. Think public schools, government buildings, airports. Because they are immune, they never even get onto the appraiser's radar. They are completely outside the taxable realm and are simply not assessed for property tax purposes at all.
Now, before we move on from special classifications, we absolutely have to talk about Greenbelt Laws. Florida provides some highly favorable tax treatment for agricultural land through these regulations. This basically acts as a unique protective tax shield. It ensures that as long as the property is being used for legitimate, bona fide agricultural purposes, the owner isn't getting taxed at the much higher rate of the commercial or residential development springing up around them.
Section 2. The taxable value formula. Let's look at the foundational math.
The absolutely crucial formula to remember is this. Taxable value equals assessed value minus exemptions. I want to pace through this deliberately because this single equation is literally the heart of property taxes. The county determines that assessed value, right? But the only way to lower the overall property tax bill is by driving down the taxable value. And how exactly do we do that? By stacking up as many legal exemptions as humanly possible.
Which brings us to Section 3. Florida's Homestead Exemption.
First things first, timing is everything. To qualify for this massive benefit, a new property owner has to file an application with the County Property Appraiser's Office, and there is a strict application window between January 1st and March 1st. I literally cannot emphasize this enough. Missing this strict window means your client misses out on huge savings for that entire tax year.
Let's break down how this exemption works because it happens across two distinct tiers. The first tier reduces the assessed value by $25,000, and that applies to all taxes, county, city, and school board. And real quick, your verification code is 698741. Okay, now regarding the second tier, this provides up to an additional $25,000 reduction, but this only kicks in for assessed values above $50,000. And crucially, this second tier applies only to county and city taxes. It does not shield the homeowner from school board taxes.
Let's look at a specific math scenario to really lock this in. Say you're reviewing a property record, maybe file number 297415, and it has an assessed value of $60,000. It clearly gets that first $25,000 exemption. But for the second exemption, which only applies to the value between $50,000 and $75,000, we only have $10,000 of value sitting in that bracket. So this property qualifies for exactly a $10,000 second exemption, assuming all eligibility requirements are met.
Section 4. Additional property exemptions.
Florida is actually pretty generous to folks who meet specific criteria. First, there's an additional $500 exemption for blind individuals as well as widows or widowers who haven't remarried. Second, veterans with at least a 10% service-connected disability are entitled to an additional $5,000 exemption. And brilliantly illustrating Florida's commitment to its most vulnerable residents, there's a 100% exemption for certain permanently disabled individuals and quadriplegics. This is a massive impact. It means absolutely no property taxes are owed on the qualifying property.
And finally, Section 5. The Save Our Homes protections.
To unlock these long-term protections, the property has to be defined as a homestead property. Quickly establishing this definition, it simply means the property is occupied by the owner as their primary residence. If it's a rental or a vacation home, these protections just don't apply.
Once homesteaded, homeowners gain two distinct superpowers. First is the assessment limitation. This strictly caps the annual increase in the property's assessed value to the lesser of 3% or the Consumer Price Index. Over time, especially during booming housing markets, this shields homeowners from skyrocketing taxes. Next is the portability benefit. If a homeowner decides to move, they don't lose that shield entirely. Florida allows eligible homeowners to transfer some or all of their accumulated tax savings to a new primary residence within the state, which lowers the taxable value of their next house.
But here is the critical fact that catches so many new buyers off guard. The assessment limitation is tied to the owner, not the structure. When a property is sold, those accumulated property tax savings absolutely die with the sale. The new owner does not inherit the previous owner's artificially low assessed value. Instead, the assessment resets completely. That means the new buyer is assessed based on the property's current, real-time market value.
Which brings us to the most important takeaway of this entire explainer. When ownership transfers, taxes reset. A buyer might look at the current owner's tax bill and think, oh, that's what I'll pay, but they are in for a rude awakening. As a future real estate professional, are you prepared to guide your buyers through that sticker shock? Understanding these formulas, exemptions, and limitations is your responsibility, so you can clearly project how property taxes will change the very moment the keys change hands. Thank you for joining me for this explainer on taxes affecting real estate.